Hi, and welcome to this morning's early global view. It is currently just a bit after 8 a.m. on Thursday, March 31st, end of the quarter. And we're coming to you a bit later than usual because we wanted to see the U.S. weekly employment numbers, seeing as employment is going to be fairly important tomorrow. The U.S. major employment being released on the first Friday of the month as usual. But we have to say, in general, just within the last day or so, the data has become better. And, of course, what we learned from Janet Yellen was that the Fed is quite a bit more dovish than some of the minions had stated last week and early this week. So her Tuesday morning speech was basically the big dog telling all of the mutts who were yelping about rate hikes sooner than not, April is live, to stand down. And that, of course, had a very encouraging effect on the equities and really hurt the dollar and didn't really hurt the govies much. So we're going to take a closer look at that in the analysis. And that is going to be interesting. So what has all this meant to the markets? Well, it's pretty easy to spot the Janet Yellen effect. You know, as we said in yesterday's concise update, you go back to Tuesday and see right at 11 when the text of her speech was released, and it was obvious she was being quite a bit more dovish. In fact, in yesterday's write-up, we had a link out to her speech, our highlighted version, and there were actually portions noted in there where she not only said the next move in rates could be down, depending on the data, Fed's back to being data dependent, but also, if conditions get bad enough, the Fed could revert to reinstituting quantitative easing. So this is a real shock to the system. It almost makes some of those more hawkish members look foolish. If she was trying to just get them to pipe down, I think she was probably pretty effective. And you can see where it shot up out of the early test, only getting back to the top end of 2020 to 2010, and then on a holding pattern until her speech text was released, and then immediately pushed back up to the 2035 area, and by later on in the day had pushed up, in fact, all the way up to near 2050 again, the next interim resistance. And then on a gap higher on Wednesday, it actually got above that 2060 resistance, but on current form, it is actually sitting here fairly steady, down one at 2054. So not much to say right now about a market where, again, sitting here at 2054, and the next higher resistances are 2075 to 85. Lower support is back at 50 initially, but the bigger support will be back into that 2035 area once again. And that pretty much does it for the short-term view of the S&P 500. In fact, this whole analysis is going to be a bit more concise because a lot of things are conforming to contingencies we discussed previous.